Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include the proper way to use AI, my interview with Pylon's Trent Hedge on why the concept of a mortgage factory that requires hordes of people, middleware, SaaS, and capital markets intermediaries is no longer the best way to originate a mortgage, and his Fed decision day.
I'm all for making homeownership more accessible and affordable for everyone. I think that's where Credit Expert comes into the picture. They're an all-new credit optimization platform that helps you close more loans. And they're committed to making homeownership affordable for all. To learn more, visit creditexpert.com. No E in expert.
Today I find myself in Vancouver, Washington, splendid in the autumn, to meet with various mortgage folks and especially the Banner Bank crew, covering much of the West. Artificial intelligence is on most agendas these days, and I received this note. Quote, I heard in your commentary that AI use in large companies is decreasing. AI is like GPS. I used to know how to get everywhere, but young drivers just plug it into a GPS. Without it, they're lost and don't know how to give directions. I learned loan programs, down payment programs, and watch rates, etc. Now new hires plug the loan scenario into AI and wait for the results. Why learn to calculate income when there's an app for that? Switching gears slightly, Union Home Mortgage, a high-growth independent mortgage banking company with world-class culture, announced today its acquisition of the origination assets of Sierra Pacific Mortgage Corporation. The acquisition, UHM's second this year, makes UHM one of the 15 largest independent mortgage bankers in the country with over $15 billion in annual originations. The acquisition includes both retail and wholesale channels of SPMC and adds the existing branches and wholesale broker relationships to UHM. And of course, it's FOMC decision day, where a rate cut is expected. Markets took yesterday's heap of stronger than expected economic data in stride, including robust retail sales and rising import-export prices in August. Both reports pointed to ongoing consumer resilience, but emerging inflation pressures. Retail sales beat expectations both with and without autos, suggesting spending remains solid even as prices rise. While a notable 0.4% increase in non-fuel import prices raised concerns about potential tariff-related inflation. Industrial production edged up modestly, driven largely by motor vehicle output, while capacity utilization remained below its long-run average. Despite this economic strength, markets remain confident that the Fed will cut rates by 25 basis points to a target rate range of 4.00 to 4.25%, and signal a belief that current data won't derail the easing trajectory. A well-received 20-year bond auction and a weaker dollar added support to bond prices, while the Senate's confirmation of Stephen Miran to the Fed board and the court's decision to uphold Lisa Cook's position set the stage for a fully staffed FOMC vote this week. For today's interview, I wanted to welcome onto the show Pylon's Trent Hedge to discuss why the concept of a mortgage factory that requires hordes of people, middleware SaaS, and capital markets intermediaries is no longer the best way to originate a mortgage. One that's transformed through AI from a mortgage factory into software.
Trent, I'm going to do a terrible job here reading off the website, but it's programmatic mortgage infrastructure for a variety of companies, fintech, banks, independent mortgage companies, originators. If you could explain what kind of that programmatic infrastructure means and how it can help scale businesses, and then also your background, that'd be a good intro.
Yeah, I'll start with my background. So before this, I built a marketplace for building custom homes online. And about 95% of our customers were asking to finance through us, and we did not have mortgage capabilities, or we were not a mortgage company. And it was the number one predictor of whether or not someone would transact on the platform. So I looked into building a mortgage business and looked at some of the really big companies who have built mortgage companies in-house, or mortgage lenders in-house. Names that come to mind would be like Morgan Stanley, Lennar, Zillow, SoFi. And across those, they had spent hundreds of millions of dollars and usually acquired multiple companies in the process. And so the immediate reaction was, we probably shouldn't do that. But the reason that it's so hard is that what we would describe as the mortgage factory problem, which is you're building a factory to manufacture collateral across processing, underwriting, closing, post-closing, QC, whatever, right? And if you look, last year, according to the Freddie Mac cost to originate study, the average lender lost $600 per loan. And the cost to manufacture was close to $12,000. And so as you're building this quote unquote factory, you're constantly right sizing human capital to match demand. And so when demand is constantly outpacing supply, meaning human capital, your economics are right sized or are positive. And when demand is either flat or fluctuating or contracting, you are upside down on your economics. And so, because when you're growing, you can just keep hiring people into the problem, right? And so that is probably the biggest challenge, aside from the fact that, of course, post GFC became incredibly regulated, the cost to do business went up, whatever. But that is sort of the core challenge that exists, is this mortgage factory problem. And at the time, we actually incubated my last business with the founder of OpenAI, and I had seen a lot of what was coming very early on before it was public with OpenAI. And so the way we think about it is that mortgages are, instead of having an automated process within your vertical SaaS or your LOS point of sale and sort of doing this incremental automation, we believe mortgages are going to API calls. And it's not that hard to believe that, because if you look at every other financial product, whether it's stocks, bonds, crypto, treasury products, they've all become API calls. It's just that mortgage has been so human labor intensive for so long that it's sort of hard to skip ahead to that point mentally. And so having now seen having seen what was happening in AI at the time, decided to go start this business. A lot of our investors had became early investors in Pylon, and it was sort of a natural genesis for the business. Now we're really focused on making mortgages fully programmatic. So building the infrastructure from taking an application all the way out to loan settlement. And we really started with the capital markets first, which is an important concept. I think a lot of times folks have focused on one specific part of the origination process, or starting with like the consumer experience and working backwards and maybe never getting there. The capital markets are the foundation of everything that we do. And we've partnered with some of the biggest banks on Wall Street and hedge funds, and now increasingly other capital providers across the ecosystem to build fully programmatic rails and execution for mortgage originations.
Yeah, I'll flex for you a little bit here. Peter Thiel is involved. And it was cool hearing you mention SoFi, because I was an original employee, and actually Mike Cagney is supposed to come out to my house and fish today. So he's so close with him, and it's cool to hear that. It has plagued the mortgage industry for forever, this cyclical nature, which everybody knows. Times are good, times are bad, and the Fed kind of exacerbated that problem by making such easy monetary policy during the pandemic. And they pulled demand forward, 7-year cycle kind of into 2 years, and so we went through this boom and bust. And the mortgage industry, despite knowing how cyclical it is, it's almost like when times are good, it's a sailor on leave, drinking on shore type of thing. Times are good, I'm not worried about the bad times. However, this last cycle made it, at least in my opinion, where companies now recognize the need for efficient scalability, up and down, both ways. And so it's good to hear that you are tackling that problem. I just wonder, when I first started in the industry, I got out of I graduated University of Texas in the early 2010s, and I joined SoFi, and it was the talk of this end-to-end digital mortgage, the digitization of mortgage. And 10 plus years later, almost 15 years later, we're still talking about it. Have we finally reached the point where home affordability is so bad, or whatever is going on in the market has finally made it where it's now it's become necessity? Like what is it about now that's actually allowing for us to be at this point where we can offer this end-to-end digitized mortgage, what a digital millennial expects? We've known we want it. Why is it taking so long to get here?
Yeah, I would argue that it's what I described with the mortgage factory problem. So if you look at all of the software that's been built, it's mostly around, well, entirely around speeding up various portions of those conveyor belts, right? So can we make underwriting 15% more efficient? Can we make processing 25% more efficient? And the reality is that usually you have somewhere between 10 to 15 different systems that are interacting with one another, and they have to be converging towards the same standard or future, and even underlying data model to be able to automate everything that sits on top. And so that frankly just hasn't worked. Like if you look at what's happened in the last 15 years, despite all of these new point solutions and seemingly modern software, the cost to originate has continued to skyrocket. So I think believing that like the next point solution that you can tack onto your factory is going to save your problem, save your economics or help you is sort of a fool's errand. In our case, in order to deliver fully programmatic execution, I think there was a world where 5 years ago we could have spent billions of dollars building really advanced machine learning models. It was technically feasible, just outside of the realm of what a company could feasibly do with upfront R&D. Now it's more like hundreds of millions, and post some of what we've seen in AI. And so I think maybe the difference is that we view it as you have to solve for the entire value chain and build underlying infrastructure starting at the base, which is the capital markets, because the capital markets ultimately determine what the loan needs to look like, and then be willing to fully build a fully vertically integrated stack on top of that and spend the money on R&D required, which is not easy. It requires a lot of upfront building, and sort of doing something that is maybe semi-contrarian relative to the mortgage ecosystem of everyone plays their individual part. But I think that's what's required to really solve the problem.
There's two kind of big problems here, or issues with his, legacy issues. Capital markets. David said that the capital market essentially determines what the loan needs to look like. The other problem is the human element, which leads to certain inefficiencies or drives up costs. And I'm not advocating for taking away people's jobs here. I'm advocating for people being more productive through technology. Let's make that distinction. But let's address each of those problems one by one. We've seen kind of a shift where capital is now more open to new products or underwriting methods, whatever it might be, incrementally and slowly. I've said for a while, historically, the industry has been very good at finding debt obligations, but not good at finding income sources. I might have a small home in the woods here, but they don't want to use that income, unless it meets certain parameters. Bring us in to some of these discussions you've been having with capital providers and how you've been able to convince them that, this is great paper.
Well, think about it historically. So if you want to spin up a new loan product in the capital markets, what do? You go develop your guidelines. You do it in concert with some of your originators who want to support this product, or maybe it's coming from demand from a specific originator that you want to go do this with. And you then need to go train the underwriting staff on underwriting against those guidelines and effectively ingrain the same tribal knowledge that they're using today to underwrite like a standard conventional conforming loan. Most underwriters aren't looking at the guidelines when they're underwriting a conventional conforming loan. They know them, and so same thing goes for these custom guidelines or new products. You need to train them, and then post transaction, you're typically exporting a file, throwing it over the fence to the takeout or the buyer of the loan. They're going to re-underwrite it or due diligence it, and you're hoping that you're correct. And on a new product, there's a big hope factor because you have not yet trained your staff through many years of experience, and so there's a lot of risk involved with rolling out new products. And in our case, we can effectively ingest any set of guidelines from the capital markets and then programmatically execute against those guidelines. And so we don't go through that same process of needing to train this underwriting staff. We also don't go through the same process of lobbing it over the fence at the end due to what we've built with the capital markets. And so an example of this is I can't yet share the details. It'll be on them to share. But we are working with a publicly traded company who is rolling out a very new, exciting product. And it turned out that one of the banks on our platform was really interested in supporting that. And so they produced a set of guidelines for that originator. We were able to support those guidelines in a matter of a few days. And now that originator, that publicly traded business can go roll out this product effectively with zero overhead from their perspective. They also don't have a factory themselves. They're building out a handful of loan officers to go support this business and relying on our programmatic execution to handle everything else. And so you've effectively cut down what is normally taking months of build out in your LOS, setting up all sorts of rules and conditions, training the staff, and effectively eliminating all of that. And so I think part of the question here is like, what is the substrate that is enabling new products? Because as it stands today, you have to have a lot of volume and a lot of confidence if you're going to go roll out a new set of guidelines, if you're one of the big capital markets players. If you're not, if you're a small balance sheet business, you might be willing to do it for lower volume amounts. But your cost of capital is normally going to be higher. And so the ability to roll these new products out at scale with the largest buyers of loans and institutional capital markets is really important.
The other part of what I said is about the human element here. And I think that's important. There's been talk of disruption for a long time. And maybe originally it was, hey, let's displace the real estate agent. And then we realized, hey, people want to be, walk into a house and have somebody hold their hand and tell them about the school district, yada, yada. Then it was, hey, let's disrupt the originator. Their comp is crazy, and a lot of this stuff can be answered through an AI chatbot. Well, it almost seems now we move past that to, well, the underwriter and the processor are the ones that can be disrupted. And if you think that's going to be where we stick, or if we're going to evolve to other parts of the process, where you see the biggest efficiencies coming from a human capital element.
I mean, yeah, the entire foundation of our business is making the origination process a set of API calls. So I very much deeply believe that what we're talking about is possible. And I do think you have to re-underwrite your priors. I agree that a lot has been tried in the past, but we have this fundamental platform shift that has taken place, and I do think it requires rewiring the entire value chain versus a portion and hoping that the next guy does their job too.
What does an API call mean for people that might not know on this?
Oh, sure. So yeah, I mean, a good example of this, I liken where we are in mortgages today to what payments looked like prior to Visa. So before Visa came along, every merchant was handling their own payments. There was a lot of paper involved. People were buying software products at the time, very early software products, or to process these payments in a localized fashion. They might be working with local banks. And then Visa came along and effectively built a standardization layer or a network that is accessed now through API calls. At the time, the technology was a little different. When you go and buy something online, there is an API call, which is application programming interface, but is the textbook definition. But it basically just means software that does not have a user interface that you're clicking a button on. So something is happening in the background, and you're making that API call to the payments processor, which is then using the underlying rails or network. Usually Visa, MasterCard is actually processing the transaction under the hood. There are lots of folks involved, but ultimately payments have become this API call driven business, as have the other financial products that I mentioned. And so today, the initial thought process is, how do we go incrementally automate portions of what's happening? But I actually think that is sort of not doing that re-underwrite of the platform shift. That is believing what has happened for the last 10 to 15 years. We've been in this incremental land. And again, it hasn't worked. So we see going to this future of API calls where you can hit the API, get an underwriting decision, and effectively have these fully programmatic or instantaneous transactions. Now, the regulation also has to catch up with that because today you could have a fully programmatic origination, but you would still be sitting there for the TRID timeline, which sounds really silly when you think about it. And so that we'll continue to see, and fortunately, I think the current regulatory environment is leaning more aggressive. But I think we'll continue to see the regulations or catch up with the underlying capabilities.
I agree that regulations will catch up with the underlying abilities. I've heard AI companies say, "Don't boil the ocean." Find things. And so you're saying, let's boil the ocean, throw the baby out with the bathwater. I'm already doing this. We can do it. Which is, I'm excited to see which philosophy wins out. But please go on. I interrupted you.
Well, it takes multiple years of building and looking slightly insane to pull it off. So yeah, we could talk more about that another time. But yeah, back to the question of AI and where things are going. The real answer is that nobody knows for sure, right? We're all making bets. But I remember a couple years ago when this was first emerging as a hot topic, and I heard a lot of people talking about automating like chatbots and automating portions of what loan officers are doing. And at the time, I was like, "There's no way this is the most valuable application of AI." And they're ultimately that is the most valuable part of the entire mortgage transaction is the people interfacing with the borrower. In an ideal world, we would love to go free up all the people doing remedial back office work to go spend more time with borrowers. And I don't think any borrower leaves a mortgage transaction thinking, "Oh, that person who was on the collateral desk underwriting the appraisal really pulled through for us." And so I think there's a misconception of people, sort of what happened 5-10 years ago. People focused on digitizing the upfront application process. That same thing has happened over the last couple of years, where a lot of people have been focused on applying AI in areas where either don't really matter or are maybe the opposite of where we should be focused. I think that's starting to change. But now it's sort of changing into this like incremental version of how do we automate portions of what people are doing. And so the tricky part is that if you can't just throw a mortgage at an LLM today and say underwrite the mortgage. We all know that no one can trust those outputs. And so the real thing is you have to build comprehensive systems that allow you to get to accuracy 100% of the time, because you can't be right 90% of the time in the mortgage industry. So that's where the real value comes into play is those who are spending time, which requires, frankly, a lot of resources to get to 100%.
Yeah. Plaid data exists out there. These APIs exist where we should be able to underwrite you earlier in the process. We should be able to pull home insurance forward in the process, title forward in the process. That to me,
AUS.
Yeah, all that stuff forward in the process.
I feel like we're kind of right now at a healthy debate. We're debating the inputs of the things that, like, we're talking about the experience to the borrower. We're talking about automating underlying back office work. At the end of the day, borrowers don't really care nearly as much about either of those things as we like to believe they do. They really care about the rate. And so, everyone I think everyone likes to talk about everything else because they don't control the rates. Right? The capital markets control the rates. The Fed controls the rates. I'm talking about the end originators here, not the capital markets or people running mortgage banks. But from our perspective, a big part of why rates are the way they are is not just whatever the 10-year is saying tomorrow, but rather all of the middlemen that exist in the capital markets. So if you think about a wholesale lender, for example, they are taking rates. The top, there's a power law. The top wholesale lenders have access to the best capital markets because they have the most volume, right? And they are taking those rates and they're marking them up, usually anywhere from 40 to 200 basis points. And as rates improve, those spreads continue to blow out. And the reason they have to mark them up so much is because they have this factory. They have tens of thousands of people that they employ, millions of square footage of office space, or at least hundreds of thousands. And they need to go pay down those costs and whatever margin they need to operate, either as a publicly traded business or as a private business. And so I think that what we're talking about with automating underwriting, eliminating the factory is actually just an enabler to go bring down the cost of rates, which is what borrowers really care about. And that's why, like for us, we started by saying, how do we go strip out a lot of the middlemen involved in this transaction? Let's go directly to the securitizers and pass those rates through directly to an originator. So David today on the platform can go price a loan directly to Citi's mortgage trading desk, for example. We don't add any margin in between. And we can dramatically bring down the costs by eliminating that factory that sits in between. So I don't know, I'm sort of talking our own book here with how we think about it, but I think that irrespective of if you believe that our approach is the right one, the more important takeaway is that we should probably focus more on how to bring rates down systemically, as opposed to better experiences. I don't disagree that those things are important, but they're sort of important at the fringe.
Yeah, and I will agree with you that it seems like everybody has their hand in the pot, and the borrower is the one that loses. If I buy $1 million house over 30 years, I'm paying $1 million in interest, and that's getting divvied up here, there, and to line other people's pockets, or buy professional sports teams or whatever it might be. I'll disagree with you slightly on semantics, and I would say that I think the uneducated borrower cares about rate. I think the educated borrower these days cares about payment, because we'll see that a difference in eighth or a quarter in rate is a double-digit thing a month versus what's my property tax, what's my insurance premium. Those things are making a much larger difference these days. And so I think educated borrowers out there, and I think good loan officers that are advising their clients are saying, let's focus on the overall payment. And granted, with stripping out a lot of this middleman, we will see that come down. I do want to give you last word. You're not going to have time to disagree with me on what I just said, but I will give you the last word.
I agree with you, actually.
Okay. I kind of want to put this all, wrap it up holistically here. What does it take for, mass adoption of what we're talking about? Is there a tipping point? Because obviously there's, the bleeding edge has been happening for a while. When do we get to kind of tipping over to where this becomes more mainstream?
I'm probably looking at it through the, maybe the internal Pylon lens. I certainly agree with you. I guess the point I was making is if you have an awesome experience, but the rates are really high or the monthly payment is really high, it might not matter. But if you have strong rates and strong ability to go structure high quality loans, and then you deliver a great experience on top of that, then it's very powerful. This is where we work really well together. You can go build an amazing experience on top of our APIs, and we can make sure the rates are low.
And customers will win.
Yeah. Historically, it's been product, price, service, pick two. You can't do all three. It sounds like we're getting to a place where we might be able to do all three, which is really neat. Trent, I'm not going to let you go without answering that question. Thoughts on when this will become mainstream? What will push it over the edge?
Yeah, well, I think you never really know what's happening until you look back in history, meaning like the change that we're undergoing as an industry now will be obvious like 5 years from now, and we'll look back at this, right? So it's always tough to say in the exact moment, but I do think that I'll leave it at this. I can't predict with a crystal ball how the market converges. We're making a pretty big bet that we converge into this programmatic future. And the lack of change in the mortgage industry over the last 30 years, in my opinion, is directly proportionate to the change that we will see in the next 5 to 10 years post AI. And some industries are not, like payments, as an example. They're already so efficient that there's actually not a lot of room for efficiency. Mortgages are so inefficient that there is an incredible amount of room. So that's the bet I will make. The exact timing and sequencing of it, I will leave to the market.
Yeah, and I'll tell you in 5 years, we still won't have remote online notarization adopted in all 50 states because of regulation. So good luck to all of us. No, I really enjoyed the discussion today. I thought this was fantastic. Trent, it's a pleasure to make your acquaintance. Hopefully this leads to more discussions amongst us.
Today's highlight will be the latest FOMC events with the statement and updated summary of economic projections released at 2 p.m. Eastern, followed by Chair Powell's press conference at 2:30 p.m. While a 25 basis points cut is a done deal and markets are priced for another 2 cuts over the rest of the year, market participants will be interested in what the dot plot has to say. The median was 2 cuts for the year previously. While there could very well be a growing list of dissenters, with both Governors Murrin and Cook voting at the meeting. The market is becoming increasingly comfortable with the idea that monetary policy will move below current restrictive levels and settle near neutral, thought to be just below 3%, by the end of 2026, barring a significant inflationary or geopolitical shock. Before the Fed, today's economic calendar kicked off with mortgage applications from MBA, which increased 29.7% from 1 week earlier, due to rates being at their lows of 2025. We've also received August housing starts and building permits. Starts were down 8.5%, permits down 3.7% at 1.312 million annualized. Both were weak. And we begin the day with agency MBS prices roughly unchanged from Tuesday's close. The 2-year yielding 3.51 and the 10-year yielding 4.02 after closing yesterday at 4.02%. Two pirates have just finished developing a machine with the ability to think and learn. The first pirate says, "This is amazing. You should come up with a name for this." The second pirate says, "AI, Captain."
Thanks again to Credit Expert for sponsoring this week's podcast, the all-new credit optimization platform that helps you close more loans. Credit Expert is committed to making homeownership more accessible and affordable for all. To learn more, visit creditexpert.com. No E in expert.